In this video, we are going to take the balance sheets of two companies, Nike and Starbucks, and reconstruct or reformulate them to analyze assets and liabilities not related to whether they are current or non-current, but whether they relate to the firm's operating activities or financing activities. Why separate assets and liabilities according to whether they relate to operations or financing? Operations is the sustainable source of increasing firm value. Financing, it relates to how the company raises funds. Specifically, when we're reclassifying liabilities, we're looking at how they raise funds through debt and also how they invest their excess cash. We mentioned operating and financing, which might have you thinking about the statement of cash flows. And right now you might be wondering, what about the investing activities that we are ignoring here? Well, what we do is we take the investing activities and we decide whether those investing activities relate to either running the business or putting excess cash into productive use financially. Examples of investing activities of running the business that relate to purchases and sales of PP&E or intangible assets, we're going to classify those as operating activities because they help run the business. Purchases and sales of treasury securities, commercial paper, equity securities, debt securities, notes receivable, and such are examples of financing activities where cash is either raised or put into a financial investment in order to earn a return. Therefore, what we do is we reclassify investing activities as to whether they more closely related to operations or financing. The balance sheet will be reformulated to report net operating assets, net financial obligations, and then stockholders' equity. Before we begin reformulating our two companies' balance sheets, let's review typical balance sheet accounts, specific accounts, and highlight which ones are typically classified as financial rather than operating and why. I want you to know the definitions of these accounts for two reasons. One, you're going to see them on financial statements and you should know what they mean. And two, they'll also be tested on the financial accounting and reporting section of the CPA exam. First financial asset is the most obvious one, cash. Although it will be used in operations, it is clearly a financing asset. Next is notes receivable. Remember, a note receivable is a promissory note that is issued by a company and signed by the borrower. It's a formal contract. The borrower signs this formal contract agreeing to pay a specific amount at a stated date and typically requires the borrower to pay interest. A company may issue a note receivable by giving cash to the borrower at issuance, or the note receivable can be issued at the time that the customer purchases goods and promises to pay for those goods in the future. While the issuer of a note receivable records a note receivable, the borrower, of course, would record a note payable. Accounts receivable, also called trade receivables, are considered operating, not financing, because they are typically for very short periods of time and do not bear interest. We can consider accounts receivable to be more similar to an informal short payment period provided by the seller to the buyer as a courtesy, rather than the formal lending agreement of a note receivable. The rest of these items that I've listed are various names of financial investments that you might see on a company's balance sheets. They are not all independent of one another. Marketable securities is a general term used to represent short-term, meaning less than 1 year, highly liquid investments made with a company's excess cash to earn a return above a typical bank savings rate, which bank savings rate has been close to zero since the financial crisis in 2008, and firms want a more productive use of their excess cash. Marketable securities can consist of any stocks, bonds, mutual funds, or other financial investment, as long as there's a liquid market for the asset where it can be easily sold when it's needed, hence the name marketable. Investments in short-term debt securities. Investments in debt can sound misleading. It can sound, if a student or an individual can focus on the word debt and tend to consider this to be a liability. But the key here is to focus on the word investment in debt. Therefore, it's an asset, not a liability. An investment is an asset purchased in hopes of earning a return and/or interest income. Below, I've listed out some specific types of short-term debt securities. Treasuries are government-issued fixed rate debt. They'll be short-term if they're T-bills or one-year T-note. Long-term treasuries would be the longer-term T-note treasury notes and treasury bonds. Commercial paper is unsecured short-term debt instruments issued by a corporation, typically to finance purchases of inventory or meeting other very short-term liabilities. Unsecured means that the issuing company does not put down any collateral. However, commercial paper is typically issued by very stable, mature companies and tends to be of quite low risk. Although short-term means less than 1 year, most commercial paper matures in about 1 to 6 months. For example, Apple's most recent 10K reports commercial paper of about $12 billion, or 5% of its total liabilities. The debt footnote disclosure gives more information about Apple's commercial paper issued if you're interested in taking a look at that. Certificates of deposits are funds deposited at a bank for a specific amount of time and earn a specific interest rate. Money market funds are investments in low risk and highly liquid short-term debt securities, such as treasuries and commercial paper. They typically come with relatively low returns, but returns that are higher than a savings account. Why do they come with lower returns? Well, because the investment is in safe, stable debt securities. Mutual funds, and money market funds are a type of mutual fund, are professionally managed, diversified investments that offer various levels of risk depending on the specific fund that's chosen. The funds may consist of debt, equity, other investments, or a combination of various types of investments. Investments in short-term equities and long-term debt securities, such as investments in long-term notes payable or bonds, they're considered financial assets rather than operating because they typically relate to a company's excess cash that's invested to earn a return greater than the bank's savings rate. Investments in long-term equity securities are typically considered operating rather than financial because they are usually made strategically. When a company purchases equity shares of another company, it's typically done because there's a strategic advantage of doing so. The acquired company's business model adds value to the acquirer's business. Before I move on to specific liability accounts, let's look at a quick example. Let's say that Drake Company has only 2 assets, a baby Benz and hunted bands. Can you classify each of these assets as operating or financial? Take a moment to think about it. Okay, was this your classification? If it was, excellent. Let's move on. Remember, financial assets are the company's cash investments made to earn a return. Financial liabilities are the amounts owed and are classified according to the economics that generated the liability. Notes payable are simply notes receivable from the borrower's perspective. Accounts payable are considered operating rather than financial assets or liabilities because they are very short term and do not entail interest and arise from operating activities such as purchasing inventory. Commercial paper was discussed earlier. You're seeing it again because this time we're not referring to a company's investment or purchase of commercial paper, but rather the company that issues the commercial paper, a type of unsecured short-term debt. A line of credit is an arrangement between a bank and its customer where the bank agrees to an amount that the customer can draw on or borrow at any point in time at a stated interest rate. Unlike a note or loan payable, the customer does not have to borrow anything, but knows that a loan is available if it's needed. The line of credit will only appear on a company's balance sheet if it has actually borrowed against that line of credit. Credit cards are the most common types of line of credit. The credit is there if you need it, but you're only going to see a balance if you actually use up some of that credit. Capital lease obligations are also financing liabilities. A capital lease is a method of financing an asset instead of paying cash up front. While the leased asset that the capital lease obligation relates to would be considered operating, the lease obligation itself is considered financing because if that asset hadn't been financed, it would have either required cash or some other type of loan. Bonds are a type of debt security issued by companies or governments. The issuer promises to pay the bondholder interest periodically as well as the principal at maturity. Long-term debt is a general term used to classify long-term notes payables, loans, bonds, or any other specific type of long-term debt. Remember from intermediate accounting that once a portion or all of a debt is payable within 12 months of the fiscal year end, it must be reclassified from long-term to short-term or current liabilities. It would be reported as the current portion of long-term debt. Both long and short-term components are considered financial liabilities. So this is what the net financial obligations would look like. We're going to report the company's financial obligations. Subtract from that financial assets. If the obligations are greater than the assets, obviously we're going to have net financial obligations. If perhaps the financial assets are greater, we would show the resulting subtotal would be negative, and we would report that as the net financial assets. Assets are acquired for a main reason: to generate revenues or income. Assets that are not financial are used in business operations, typically the production of goods or services for sales to customers. The operating assets are listed here: accounts receivable, inventory, prepaid assets, also called prepaid expenses, deferred tax assets, long-term equity investments. As we mentioned earlier in the financial section, we said that long-term equity investments are not financing, even though short-term equity investments are. PP&E, land, buildings, and equipment, capital lease assets, and intangible assets all qualify as operating assets. Operating liabilities, anything that's not classified as financial. Accounts payable, accrued expenses. Accrued expenses is just simply a term for all the other payables: salaries payable, wages payable, utilities payable, anything that wasn't included in accounts payable, typically non-interest bearing and results from operations. Unearned or deferred revenue, when the customer pays in advance and the company owes goods or services to that customer, unearned revenue is recorded. Warranty obligations, you can think of auto manufacturers and sellers or companies like Sears. When they're selling goods and they're promising a warranty, they promise to fix anything that could go wrong. They estimate what the cost is going to be to repair, and they record that as a liability to be reduced once the actual repair takes place. Deferred tax liabilities and pension liabilities are all examples of operating liabilities. Net operating assets would be reported. Operating assets less operating liabilities. Typically, the operating assets will be greater than operating liabilities, so you would report net operating assets. In a rare case where operating liabilities were greater, we would see a negative number in the subtotal, and we would report that as net operating liabilities. We're going to put together a balance sheet that looks just like this. We have our operating assets, net operating assets, equaling our net financing obligations plus common stockholders' equity. The next step is to watch the next video where I reformulate the balance sheets of Nike and Starbucks. Just do it, and don't worry if you need a latte practice.